Hey traders, a very warm welcome to you. So part two of this video, we're talking about ETFs. I want to outline the most popular ETFs. There are probably hundreds, if not thousands. Not sure there's a big database of them anyway, but a lot of them aren't very liquid, not very good to trade, rubbish spreads on them, no volume, waste of time. However, I've picked out some, and we've got here 1, 2, 3, 4, 5, 6, 7, 8 of the top volume traded ETFs. And I'll probably talk about some more that I know of as well. So the first one, just a reminder guys, ETF is a kind of tracking exchange traded fund. It tracks an underlying or a basket of stocks or something. It tracks a broad sector or something, and we'll look at that in a second, exactly what each one of these tracks. So let's get this pen out. Hopefully this one is better now. VXX, that tracks the short-term VIX futures. Now VIX is the volatility index. It's a component of options. When you have an options price, you have a volatility component, you have the valuation component. Broadly speaking, that is tracking that. So it's an expectation of volatility. Often when markets move to the downside, VIX is going to spike up because more people are buying insurance in the form of buying options. As more people want to buy the insurance, the price of that insurance goes up. This VIX goes up, this VIX spikes. So an easy way, instead of trading VIX futures, which are pretty challenging because they've got all sorts of different parameters, or instead of trading options and buying options to hedge your portfolio, or looking for puts to kind of make some money from the downside, an easy way or a simpler way of doing that is to trade the VXX. It's an ETF, it's priced as a stock is, but it will track the volatility component or the VIX futures. So when people get frightened, when they're perceived to be volatility, you're going to see a VIX spike. When we're generally chugging along in a bull market, everyone's happy, the VXX is going to go down to the downside. So you can trade, rather than looking for direction of the market, you can trade the expected volatility of the market. If you think people are a bit overly concerned about things and VIX has spiked up and VXX will spike up, you can short it and let it rock back to a normal scenario. If you think that something's going to kick off soon, some sort of macro event's going to cause the market to fall to the downside, perhaps a naked short is something you considered but you don't quite like, if for whatever reason, VXX is a good place to start in terms of getting exposure to that. Okay, the next one is SPY, and that is giving you exposure to, my pen is running out again, the S&P 500. Oh, that ES is the code for the futures, but it's the S&P 500. I think we're all familiar with that, guys. It's 500 stocks in the US. SPY or SPDR tracks that. So if you want a broad kind of short or long on the American 500 American companies, very easy to go into SPY rather than buying S&P 500 futures or buying 500 individual stocks. You can buy a little bit of this SPY, massive volume in it, massive liquidity, and you're going to get exposure to that. The next one, EEM, is emerging markets. So in your emerging markets ETF, you're going to have things like a basket of stocks. I think you've got like 500 or 600, maybe even 800 stocks in there for emerging market companies. So in China, Brazil, all these kind of rather than developed things, emerging markets. So you get more of a broad feel of, if you think that emerging markets are going to give you more bullish, you can, instead of trying to pick your stocks and pick and choose stuff, you can have a broad play based on that, or a broad bearish play. Equally easy to do. Okay, GDX is your gold miners, and I'm going to add to this one GLD, which is actually gold itself, so gold futures. So gold miners is basically exactly what it says. It is companies that mine gold, bigger companies that mine gold. There is a junior gold miners ETF, but GDX relies obviously on, they're just picking out the companies that are purely focused or very driven by the gold price, or very driven by production price of gold, and it's just a way of getting a broad kind of exposure to gold miners without having to pick and choose again the ones you want. But for some reason there's decent volume in that, I don't know why. QQQ, that is the Nasdaq 100. We all know about that. This is a good one, guys, because tech is volatile. Tech can be volatile. Often we want to get an exposure, we want to get a some kind of trade idea based around that. QQQ, really good way of kind of getting exposure to the Nasdaq 100 without having to buy obviously the 100 stocks. Or what you can do as a quick idea is you can buy the Q, or you can strip out maybe Amazon or Apple by shorting those individual stocks. So very easy and simple to do that. You buy say £100,000 worth of Q ETF, the Q's ETF, and then you sell maybe you know, £10,000, $10,000 worth of Apple and Amazon, so you strip that out, but you've literally got a Nasdaq but without those in. It's all sort of kind of different tricks and things you can do with that, so it's quite handy. USO is crude oil, so a mixture of front month futures and 5 month futures. Really nice, easy exposure to buy crude oil if you want to buy it, chuck it away in a portfolio. Again, this is the kind of thing that's nice with these ETFs because they're priced like stocks, so you could literally chuck crude oil in your portfolio, chuck some emerging markets, some gold miners, some S&P 500 and individual stocks. And it kind of all sits nicely. You haven't got to worry about futures and this and that and the other. So it's very, very easy to do. So that's a good one. USO, really worth watching. Here's another one. Here's Russell 2000. So the Russells is the smaller cap stocks in the US, a lot more volatile potentially. Again, you can play these little games as well where you can say, hey, listen, I think that the small caps are going to outperform the large caps, so I'll short SPY, I'll go long IWM, and then I've got the kind of differential between the two. Very easy to do with ETFs, harder to do with futures. You've got to get the right amount, your size might be a lot more. So again, a little more flexibility there. And EWZ is your Brazil ETF, quite popular one. I think it's one of the more popular ones in the range of ETFs that we've got. Gives you exposure purely to Brazil. So the fund will just pick out the best stocks they think should have the right weighting in there. And if you want to kind of buy something that's got exposure to that, then maybe you want to look and see exactly what's in there if you're that bothered. But if you just think Brazil's going to do very, very well, or it's done too well, easy way to get some exposure, add it to your portfolio, add it to your trades. But some of these are really volatile, and actually from a day trading perspective, you know, VIX, VXX, SPY, you know, gold miners, all very, very volatile. So you can take advantage of these from a day trading perspective too. Okay guys, next video I'm going to talk about some odd ETFs called inverse and different leverage types of ETF. Take care, bye-bye.